Hi, and welcome to the Basic Concepts to Options Trading, brought to you by GTL Capital Management. In this video, we will present what an option is, we will define a call and put option, and how to use them based on their key features. We will explain what a strike price is, and then illustrate them in an options table and in a bar chart. And to finish, we will explain how volatility and time decay play an integral role in the pricing of an option. An option is a contract that gives the owner or purchaser the right, but not the obligation, to buy or sell the underlying security, such as a stock or futures contract, at or before a specified date. There are two basic types of options, a call option and a put option. A call option is a contract in which the buyer has the right, but not the obligation, to buy a specified quantity of a security at a specified price called a strike price within a fixed period of time until its expiration. A put option is a contract in which the buyer has the right, but not the obligation, to sell a specified quantity of a security at a specified price called a strike price within a fixed period of time until its expiration. We will now present the risk with buying or selling an option. The risk associated with buying a call or a put option is limited to the amount you pay for the contract, also known as the premium. In the case of a call option, you would buy a call option if you anticipated the price of the underlying security was going to rise. Conversely, you would buy a put option if you thought the price of the underlying security was going to decline. The risk associated with selling a call or put option is unlimited. The seller receives the premium paid by the buyer for taking on the risk. The seller of a call option has an obligation to sell the underlying security if the option is exercised. The seller of a put option has an obligation to buy the underlying security if the option is exercised. The strike price, also known as the exercise price, is the price the underlying security can be bought or sold as defined in the option contract. We will now illustrate how strike prices are positioned in relation to the underlying security. We will use the popular exchange-traded fund called QQQ, listed at the NASDAQ exchange. The price of QQQ is $46.44. The expiration date is the month in which the option expires. In this example, we will present the $46 call option with June expiration. This option table shows the various strike prices above and below the market price of $46.44 for QQQ. This means that we have 44 cents worth of intrinsic value based on a $46 call, which is said to be an in-the-money option. Here is how the various strike prices would overlay onto a bar chart of the same contract. The price or premium for each strike level is determined by how far it is away from the underlying market price and how volatile the market is. Volatility is defined as the tendency to fluctuate sharply and regularly, or how much a security moves up and down. Volatility is calculated mathematically, and this value is calculated into the price of the premium. This is referred to as implied volatility and is the second most important price determinant for options other than the price of the underlying security itself. Another key element to the pricing of an option is time, or more specifically, decay of time. Options are wasting assets. They reduce the value of the premium over time, and this phenomenon is called time decay. As a general rule of thumb, an option will lose 1/3 of its time value over the first half of its life, then the remaining 2/3 over the rest of its life, as the time decay curve illustrates. Strategies that take advantage of time decay are those that have a net short position. Finally, the key features to employ an option strategy are the limited dollar risks and exposure to erratic price movements, the benefit of leveraging your capital. You can profit in bull and bear markets, using volatility and time decay to your benefit. This is the reason experienced option traders have profits in volatile markets. If you would like to see an actual option strategy that has been active for several years, then visit the Advanced Concepts to Options Trading YouTube video presenting the Global Volatility Option Strategy, a strategy by GTL Capital Management.